Bank of Canada is widely expected to cut its benchmark interest rate at tomorrow's decision. But of course, they have a lot of economic data to take a look at in informing that decision. Is there anything in there that could make them pause on all this? Joining us now to discuss is Leslie Preston, senior economist with TD. Great to have you back on the show, Leslie. Big day tomorrow, obviously, and as they head into that meeting with armfuls of binders of information, we have the same information. So let's take a little bit of a temperature check of the economy. Inflation seems like the place to start.
Yeah, and inflation certainly from a headline perspective did come down in the latest reading, but there is a fly in the ointment when it comes to Canadian inflation, and that's that in the most recent 3 months, services price pressures have picked up again. So while you look at core inflation, which is what the Bank of Canada tracks, they have a couple of measures, we've seen progress stall on those core inflation measures in recent months. So it's looking like the Bank of Canada is going to cut next week, but I think if they surprise markets with a pause, it will be because of those slightly stubborn readings on core inflation that we've received in recent months.
When you look at that slightly stubborn core inflation print, do you think, if they did give us a pause tomorrow and they would be able to point to that, and that would be sort of their escape hatch despite the widespread expectations, what do you make of that? Is that more of a troubling sign of where we're headed on inflation?
No, I don't think it would be a troubling sign of where we're headed on inflation. It would just be a sign of a cautious Bank of Canada, that the Bank of Canada wouldn't want to risk ignoring an upturn in inflation and cutting rates and adding fuel to the economy to trigger more inflation. But I think when we look at the activity indicators, things like retail sales, growth, things are soft in the Canadian economy. So, and I think that's why markets are focused mainly on a cut, because the indicators that would suggest where inflation will be a few months from now based on demand in the economy are weakening.
That's key, right? For the Bank of Canada, we're talking about a year and a half, 2 years out. You mentioned retail sales. We got a fresh print on that, I believe, just last week. And that was starting to indicate, I think, or we've seen an indication the consumers starting to really feel the pressures of both inflation and higher rates.
Absolutely. It was a disappointing retail sales report for May, and Statistics Canada also releases an advanced indicator for June, which, they do tend to revise a fair bit, but it's also pointing to a soft June. So we're certainly seeing on the retail front that the Canadian consumer is ratcheting back. We did have a bit of a pop higher in April, but that appears to be in the rearview mirror. And when you pull the lens back for consumer spending as a whole, we've had 2 quarters in the fourth quarter of last year and the first quarter of this year where consumer spending was running at around 3% in real terms, and our tracking for the second quarter, now that's in the past now, is closer to 1%. So we have seen the Canadian consumer really get a bit more cautious in recent months.
I think before we were so laser focused on inflation over the past couple of years for good reason. We used to be labor market focused, right? We used to worry about the jobs market. Pretty important, right? If you have money, you feel good about the economy, you buy a house, you buy things. What are we seeing on the jobs front?
Well, we continue to see a gradual cooling in Canada's labor market. If we focus on the unemployment rate, which is sort of one of the less volatile indicators coming out of the Labour Force Survey, we've seen unemployment rise in Canada. From the peak labor market tightness back in 2022 of unemployment being just below 5%, the unemployment rate's now at 6.4%, which is not a bad unemployment rate on a historic basis. It kind of puts us back in 2017. The economy was doing reasonably well in 2017. So it's come back into better balance. We expect the unemployment rate to continue to rise over the remainder of the year, but it is a bit of a unique situation in that it's not because we're seeing people losing jobs on net. It's that we're not seeing job creation keep pace with Canada's very rapid population growth. Just to put some numbers around it, Canada's population's grown about 3.4% over the past year. Jobs have grown by 1.7%, so it's half. And that's why we're seeing this drift upwards in the unemployment rate and bringing a more balanced labor market.
So that's a nice entry point into talking about the overall economy and GDP, because there has been arguments made that we may be seeing growth or even modest growth or tepid growth, but things wouldn't look as good per capita because we have been growing the population so aggressively.
Yeah, and even in real terms, GDP growth isn't fantastic. In the first quarter, we had growth of 1.7%, which is kind of the Canadian economy basically treading water, and we're tracking around 1.8% in the second quarter, so more of the same. Obviously, I mentioned consumer spending only around 1%, so we have other parts of the economy that we expect to be sort of carrying the load in the second quarter. But overall growth in Canada has been pretty subdued. We're looking at 2023 as a whole, the economy grew a little bit above 1%, and we're looking for a similar performance this year in 2024. So I think subdued is a pretty good adjective to describe where the Canadian economy is sitting right now.
So we put all of that together. The Bank of Canada puts all of it together. Tomorrow morning, we're going to hear from them. A widespread expectation, as you said off the top, is that they will deliver the second cut of this cycle. Seems like a fairly safe bet. I hate to say it, anything's a safe bet, but we seem to be leaning that way. You said there was one fly in the ointment,
the fly in the ointment is depending on which way you're looking at it. Typically we talk about inflation in year-on-year terms, and if we look at core inflation that way, it's been coming down nicely for a couple years, but just in the most recent months, progress has stalled at around 2.8% on core inflation. So still within the bank's range, that 1 to 3% range. Now, if we look at the past 6 months, core inflation's been just above 2, and we can see that probably fed in a large part to why they cut in June. They're seeing it come in, but in the most recent months, they're ticking up. So it's really about how much weight, and this is what we don't know, the Bank of Canada in their internal deliberations is putting on this upswing. Is it something they're worried about, or is it something, all this data is volatile. We saw in the US core inflation pick up in the first quarter in services, and now it's coming back down. So there's always going to be volatility along the downward trend. So we'll see tomorrow how much weight the Bank of Canada is putting on that.
So whether the Bank of Canada does cut or waits tomorrow, it is also, I guess, a widespread belief that we're in a cutting cycle now. We have reached the point where we raised it dramatically, we left it there for a while to cool inflation, and we are embarking on bringing that rate down. What does the path look like next 6 months over the next year?
Yeah, we expect continued cuts from the Bank of Canada. So overall, from here in the year, we're expecting 2 more cuts, likely tomorrow, and then one later in the fall in October. So, another 50 basis points from the Bank of Canada, depending on how the economy unfolds. It's based on our forecast. If we see growth slow further than we're expecting, the Bank of Canada may cut a little bit faster, but right now we're looking for 2 more cuts this year.
I imagine that the criteria for them even to consider going back to hiking would have to be pretty high. We'd have to sort of miss a lot of our targets here for them to get back in that mindset, saying not only do we need to pause, but do we need to reverse course?
Yes, the bar would be very high for a hike right now, particularly given, as I mentioned, the labor market's been cooling, measures of wage growth are cooling, growth isn't great. We would have to see a pretty big turn of events for the Bank of Canada to resume hiking.